Treasury stock transactions. Treasury stock is stock that a corporation has issued and then reacquired. So they issue it, but then at a later time, they buy it back from the stockholders. They do this for several potential reasons. First of all, they could reacquire those shares to be able to use them to acquire or buy another corporation. They could do it to take the ownership out of certain hands, potentially to avoid a takeover of the company. They could buy the shares back to then give to employees as compensation, or they could do it to maintain a strong market for their stock. So treasury stock is similar to unissued stock in several ways. So neither treasury stock nor unissued stock is an asset. Neither of them receive cash dividends, and neither allow the exercise of voting rights. In recording treasury stock transactions, the cost method is used. So when a corporation buys back its shares of stock from the stockholders, that is when it is called treasury stock. So when a company reacquires those shares, they will debit treasury stock at whatever cost it was to buy those back from the stockholders, and credit cash for the amount of cash that they had to pay out. Then when the treasury stock is potentially resold in the future, because that can happen, then you would have to record it with a debit to cash, so the amount of cash received for the shares sold. And then you would have to decrease the amount of treasury stock, or decrease the amount in that account. And you would continue to do that at cost. So what you previously reacquired it for, that was the cost of the treasury stock to the corporation. So you then decrease the treasury stock account by that same amount. And then any difference there will be credited to paid in capital treasury stock. So here's an example. On May 3rd, Zerbal Corporation purchased 4,000 shares of its own stock for $36,000 cash. So $36,000 cash divided by 4,000 shares. So they reacquired them at $9 per share. So that's the cost to them at that point. On November 4th, Zerbal reissued 850 shares of this treasury stock for $8,500. So they reissued it for $8,500 for 850 of those shares. So even though they reacquired 4,000 shares, they only ended up reissuing 850 of them. So those 850 were sold for a total price of $8,500, which comes out to $10 per share. So the corporation reacquired them at $9 per share and then reissued them at $10 per share. So now let's record these issues. So prepare the May 3rd and November 4th journal entries. So I have already put our journal entries here from the previous two slides so that you can see how those specific journal entries work with this problem. So it was on May 3rd that the treasury stock was recorded. That is recorded at cost. So that was $36,000, and it was purchased with $36,000 cash. So at cost, just as a reminder, this was 4,000 shares at $9 per share. Then on November 4th, when that treasury stock was reissued, it was reissued for a higher price. So the cash received on that day was $8,500, and that was only for 850 shares. So that was 850 shares, and that was sold at $10 per share to give us the 8,500. Then we need to look skip down and look at the treasury stock because we want to record that at cost, record the shares at cost. When we're recording the cash, we're recording cash at the selling price. But when we're recording treasury stock, we're recording it at cost. And the cost, when it was reacquired, was $9 per share. So that would be 850 shares times $9 cost. And that gives us $7,650. So the difference between the cash received and the treasury stock recorded, the decrease to the treasury stock recorded, is $850, which is recorded as paid in capital treasury stock.